Gold just reclaimed $5,000 per ounce on February 13, 2026. And if you think the volatility is over, you are dangerously mistaken, because what happened 2 weeks ago was not a correction. It was a warning shot, and most retail investors completely missed what it actually means. Welcome to Capital Anchor. I break down what is actually happening in markets while the mainstream media keeps you distracted. Subscribe right now because what I am about to show you could change everything you thought you knew about precious metals in 2026. Here is what nobody is telling you. On January 30, 2026, gold crashed 9% in a single trading session. That is the worst single-day decline since 1983. Gold fell from $5,390 per ounce to $4,895. Silver got destroyed even worse, plunging 35% intraday, the largest one-day drop on record for silver. Together, gold and silver erased $7 trillion in combined market value in one session. But here is where it gets interesting. Gold is now back above $5,000. As of February 13th, gold is trading at $5,066. That is a full recovery in just 14 days. Silver bounced back to $100, and every major investment bank on Wall Street just doubled down on their bullish forecasts. J.P. Morgan raised their target to $6,300 per ounce by the end of 2026. Deutsche Bank confirmed their $6,000 target, UBS's $6,200. Goldman Sachs raised their forecast to $5,400. These are not random guesses. These are on-the-record predictions from the largest financial institutions in the world. So what actually happened? Let me explain this in a way that makes perfect sense. Think of the gold market like a dam. Water pressure builds behind it. The dam holds, more pressure, still holds. Then one small crack appears, and the entire structure fails in seconds. That is exactly what happened on January 30th. Gold had surged 29.5% in January alone. That is the largest single-month gain since the 1980s. Silver had rallied 68.5% in 1 month. These are not normal moves, they are parabolic. And when an asset goes parabolic, it attracts leverage. Retail traders, hedge funds, momentum chasers, everyone piling in with borrowed money. Here is what triggered the collapse. On January 30th, President Trump announced Kevin Warsh as the nominee for Federal Reserve Chair. The market interpreted this as hawkish, less stimulus, higher interest rates, and suddenly, the narrative shifted. Gold does not pay interest, so higher rates make gold less attractive, right? That is what the mainstream tells you, and that single narrative shift caused the dam to crack. But here is the hidden mechanism. The Chicago Mercantile Exchange increased margin requirements for gold futures. That means traders who were holding leveraged positions suddenly needed to deposit more cash. If they did not have it, their positions got liquidated automatically. This is called a margin call cascade. One liquidation triggers another. Prices fall, more margin calls, more liquidations, and it feeds on itself. The Shanghai Futures Exchange did the same thing. They raised margin requirements for silver futures to 11%. They reduced daily opening position limits for silver to 800 lots. They barred 16 clients from opening new positions. This was not a coincidence. Both exchanges tightened at the exact same time, and the result was predictable: forced selling. Now let me show you why this happened. Reason number 1. Positioning was insanely crowded. Gold futures open interest had reached record highs. Silver open interest was at levels not seen since 2013. When everyone is on the same side of the trade, the exit door gets very small very fast. And that is exactly what happened. Reason number 2. Profit-taking by institutional players. Gold had nearly doubled in 12 months. Many large funds were sitting on triple-digit percentage gains. Bloomberg reported that hitting $5,600 acted as a sell signal for major institutional investors. They locked in profits. And when the big players start selling, the smaller players panic. Reason number 3. The end-of-month calendar effect. January 31st was the last trading day of the month. Funds needed to rebalance portfolios, close out positions, report performance. This created extra selling pressure on top of everything else. It was a perfect storm of technical factors all converging at once. Here is what retail investors do not understand. The fundamentals did not change. Inflation data did not shift. Central bank policy did not reverse overnight. This was purely a positioning and leverage event. But while retail was panicking, institutions were watching something completely different. Central banks bought 60 tons of gold per month in 2025. That is 3.5 times higher than the pre-2022 average of 17 tons per month. And here is the critical part. Central banks are forecast to buy 800 tons of gold in 2026. That is 26% of global annual mine output. Think about that. 1/4 of all newly mined gold in the world will be purchased by central banks, not investors, not jewelers, governments. J.P. Morgan published this data on February 2nd. They said central bank buying is a structural trend that is not exhausted, and they are right. Poland's central bank held 550 tons at the end of 2025. Their target is 700 tons. China extended their gold buying streak to 15 consecutive months. India's pension funds are increasing allocations. This is not speculation. This is documented institutional accumulation. While you were being told that gold crashed because of Fed policy, central banks were quietly adding to their reserves. The World Gold Council reported that 95% of central banks expect gold reserves to grow in the next 12 months. That is the highest share ever recorded. And 43% plan to increase reserves aggressively, another record. So here is the disconnect. Retail investors saw a 9% crash and panicked. They sold, they took losses, they swore off gold forever. But institutions and central banks saw a buying opportunity. ETF inflows remained positive on January 30th, the day of the crash. Physical gold premiums widened. That means the paper price crashed. But physical buyers stepped in. This is the game. While retail reacts to volatility, institutions accumulate during volatility, and the data proves it. Gold ETFs posted inflows for 8 consecutive weeks leading into February. Total ETF holdings increased by 500 tons year over year. J.P. Morgan forecasts 250 tons of ETF inflows in 2026. Goldman Sachs sees 275 tons. This is real money flowing into the asset. And here is what nobody mentions. Gold is now trading at $5,066. That is 3.5% above the $5,000 psychological level. Silver is back at $100. Despite the most violent sell-off in modern history, both metals are holding well above their October 2025 levels. Gold is still up 84% year over year. Silver is up 224% year over year. The trend is intact. Now here is where most people completely miss the real story, because this exact pattern has played out before. And what happened next changed everything for those who understood it. Go back to March 2020. Gold crashed 12% in 2 weeks. Pandemic panic, margin calls everywhere. Leverage traders liquidated. Gold fell from $1,702 to $1,491. Everyone said the bull market was over. Central banks would sell to raise cash. Inflation was dead. Gold was finished. What happened next? Gold bottomed on March 16, 2020, then rallied 40% in 5 months, hit $2,067 by August. That is a $576 gain per ounce. Anyone who bought the crash made generational wealth, and the exact same fundamentals that drove that rally are present right now, only amplified. Here is what has not changed. U.S. government debt is $36.2 trillion, that is $108,000 per citizen. The Congressional Budget Office projects $2.6 trillion deficits through 2034, every single year. This is not going away, and gold is the hedge against fiscal insolvency. Second fundamental, real interest rates are still negative when you account for true inflation. The Fed funds rate is 4.5%, but consumer price inflation is running at 3.8% annually. Subtract them. You get 0.7% real yield. Meanwhile, food prices are up 28% since 2021. Energy is volatile. Housing costs have surged. Negative real rates make gold attractive. Always have, always will. Third fundamental, central bank diversification is accelerating. Russia holds 33% of reserves in gold. China is at 5.2% and rising. Turkey is at 32%. Countries are moving away from dollar dependence. That is not a conspiracy, that is documented monetary policy, and it creates structural demand for gold that does not exist. for stocks or bonds. Fourth fundamental, COMEX gold inventories are declining. Registered gold available for delivery dropped to 10.8 million ounces in January. That is down from 12.3 million in October. Less physical supply in the warehouse means tighter market conditions. And when paper contracts exceed physical availability, prices rise. On the record, screenshot this. Gold will hit $6,000 per ounce by September 2026. That is a 18.4% gain from current levels in 7 months. Why? Because central bank buying will not stop. Because ETF inflows will continue. Because physical demand from India and China will accelerate into wedding season and Diwali in October. And because volatility shakes out weak hands and strengthens the bull market. Let me give you the 3 scenarios with probabilities. Scenario 1. Gold consolidates between $4,800 and $5,400 through April, then breaks out to $6,000 by September. Probability 65%. This is the base case. The volatility scared retail out. Institutions accumulate quietly. Then the breakout happens, when everyone is looking elsewhere. Scenario 2. Another volatility shock drops gold to $4,500 in March or April. Then V-shaped recovery to $5,800 by year-end. Probability 25%. This happens if geopolitical tensions ease temporarily or if Fed rhetoric shifts hawkish again. But fundamentals bring buyers back quickly, just like January 30th. Scenario 3. Gold goes parabolic immediately. Hits $6,500 by June. Probability 10%. This requires a major catalyst, banking crisis, geopolitical escalation, currency collapse somewhere in the world. Low probability but possible. And if it happens, the move will be violent and fast. Now let me break down what you should actually do. This depends entirely on your position. If you are holding physical gold, do nothing. Volatility does not matter to you. You own the asset. Central banks are buying alongside you. Your time frame is years, not days. The only action is $2 cost average on dips below $4,800. If you have cash available. If you are using leverage or trading gold futures, reduce your position size immediately. The margin calls on January 30th destroyed accounts. Many traders turned $50,000 into zero in one session. Leverage amplifies gains but also amplifies wipeouts. If you must trade, use no more than 2x leverage and set stop losses. 8% below your entry. If you are sitting on the sidelines with cash, start building a position now. Do not wait for the perfect entry. You will not catch the exact bottom. But $5,000 gold is a reasonable entry point given the $6,000 target. Split your allocation into 3 parts, buy 1/3 now, 1/3 if gold dips to $4,700. Final third if it drops to $4,400. If you bought gold at $5,300 in January and are underwater, hold. You are down 4.4% right now. That is nothing in a bull market. The recovery is already happening. Do not sell at a loss out of fear. The thesis has not changed. Your mistake was not buying gold. Your mistake was buying too much too fast without leaving. Room for volatility. Here is what you need to watch going forward. First, watch the DXY US dollar index. Gold and the dollar move inversely 80% of the time. If DXY breaks below 106, gold will rally. If DXY spikes above 110, expect short-term pressure on gold. Second, watch COMEX registered gold inventories. These are reported weekly. If they drop below 10 million ounces, that is a major supply squeeze signal. Physical demand is overwhelming paper supply. That setup leads to explosive price moves. Third, watch central bank purchase reports. The World Gold Council publishes monthly data. If monthly buying stays above 50 tons for 3 consecutive months, that confirms the structural trend is accelerating, and it supports higher prices. Long term. Fourth, watch the spread between physical gold premiums and paper prices. If premiums widen, that means physical buyers are willing to pay above spot. That is bullish. It means the real market is tighter than futures pricing suggests. Now let me tell you about the 3 types of people watching this video right now. The first type is panicking. They sold on January 30th. They lost money. And now they are angry at gold, at the market, at themselves. They will miss the next rally because fear controls their decisions. The second type is frozen. They are holding but they do not understand why. They are scared of another crash. Every price drop makes them reconsider. They do not have conviction, and without conviction, they will sell at the worst possible time. The third type is learning and preparing. They understand that volatility is part of every bull market. They saw the January 30th crash as a reset, not the end. They are tracking the data, they are watching central banks, and they are positioning for the next leg up while everyone else is still traumatized. Which type are you? Your answer determines your outcome, because markets do not reward comfort. They reward preparation, and the biggest wealth transfers in history happen when everyone is too scared to act. Here is the truth that nobody wants to hear. Wealth moves from the impatient to the patient, from the emotional to the analytical, from those who react to headlines to those who understand mechanisms. January 30th was not a crash. It was a transfer event. Leveraged speculators lost billions, central banks and institutions gained physical ounces, and that pattern will repeat every single time retail panics. Gold just reclaimed $5,000, and volatility is far from over. But now you understand what that volatility actually means. It is not the end of the bull market, it is the fuel for the next leg higher, because every shakeout removes weak hands and strengthens the foundation. If this breakdown helped you see what is really happening, hit the like button right now. Subscribe if you want to understand markets while everyone else stays distracted, and share this video with someone who is still confused about what happened to gold in January. They need to see this. Drop your answer in the comments. Are you holding through the volatility or did you sell? I want to know where you stand right now.